Hey, what's up, everybody? It's Friday, October 22nd. We're going to go over a few things in the market. Updates this week. Obviously, you know me, Joe Robert. And, today I have Justin Green. He's kind of an OG, been in the crypto space a while. We're blessed to have his presence today. Justin, why don't you give us some more insights about yourself?
Sure. Yeah. So OG is one way to describe it. I've been tinkering with crypto more or less since 2011, when I first heard about Bitcoin, and ever since then I've been hooked. Very, very interested in the space and the technology. I also do some trading and investing, and that's done pretty well over the years. And these days, I'm really into DeFi and DAOs. Anything in that territory really interests me, and I'm involved with some projects on the development side, and I continue to invest in the space. And obviously, the last year or so has been great in the markets, and things are really picking up from an innovation standpoint. And my eyes are just glued to the screen right now with everything going on. So we'll have some interesting stories today to talk about. And right back to you, Joe.
Since you've been in a while, what has been like, obviously, one of your favorite positions?
Oh, one of my favorite positions. Well, I've been a long time Ether OG. I was in the Ethereum ICO, and watching the Ethereum network go from something that pretty much everyone was skeptical about to now the number two cryptocurrency has been quite a journey. And now it's sort of flipped where you have a lot of Ethereum maximalists looking at other things that in a skeptical light. But just really being a part of that community from day zero to where it is today has been an incredible experience, and really shows you the power of cryptocurrency to bootstrap a community and create a global movement for some incredible product or incredible change.
What type of conviction does it kind of take for one to maintain a position in Ethereum as it has gone way up and has come way back down over the last 5 years?
Yeah, it takes a very idealistic type of conviction. Um, in the case of Ethereum, what really compelled me was thinking about how the entire financial system really runs on business contracts that can be expressed in code running on the Ethereum blockchain. And there was really no limit that I saw to the type of business that we conduct in real life that could migrate to the Ethereum blockchain in a much more efficient, scalable manner. And from day one, I've always seen this as sort of creating a new financial system or a new society, if you will, where code is law, quote unquote. I know some people have issues with that, but that really fundamentally is the value, in my opinion, is that we are taking all of these business agreements and legal agreements, and we are codifying it on the blockchain, running it in a credibly neutral execution layer, and gaining a ton of performance and efficiency benefits from that. In addition, we're also widening the scope because this is now a global phenomenon. Somebody in Africa can form a business agreement with someone in America by just clicking a few buttons on the blockchain. So it's really an incredible shift in how we view global finance and economics. And from day one, I always saw this as getting as big as a global monetary system or a global financial system. So that's the kind of conviction it takes to hold this through all the volatility that we've been through. But I still think that that is on the table. My eye is still on the prize, and there's still a long way to go before any crypto asset reaches some sort of global dominance. It's still a tiny part of global markets. So I still have that conviction today.
When one has a conviction in holding a position, how do you kind of, look out and kind of put an idea on how high a market cap can truly go before you sell a position?
Yeah, so you generally want to do some relative valuations. You want to try to find something similar that's providing a similar service and look at its valuation. Bitcoin people often compare to gold with something like a 7 trillion market cap. And so in my mind, that's been a reasonable estimation for what Bitcoin could be in a bullish scenario. And Ethereum does have some monetary premium itself. People are using Ether as a currency. So some fraction of Bitcoin's maximum market cap is a reasonable estimation for Ether just on the monetary premium side. But Ether also has revenue in the form of its transaction fees to Ethereum holders and Ethereum stakers. And also the burning of Ether now with EIP 1559, that is decreasing the supply, and it sort of acts like a dividend to all Ethereum holders. So that revenue is more like a cloud computing company like AWS or something, where you're getting revenue from all this computation on the blockchain. And so when you combine that sort of valuation with a monetary premium valuation, you do get significant gains from where we are today. And I certainly agree with a lot of the people in the market that are calling for $10,000 ETH this year or next year, sometime towards the end of this bull cycle. That's definitely on the table.
And you mentioned code is law, right? And I think that's kind of been brought up and questioned a little bit lately at Twitter with some certain hacks and so forth. Can you kind of give us your opinion on exactly what kind of code is law?
Yeah. So what I mean by code is law, a lot of people want to kind of put you in an extreme bucket where if you say code is law, then you're okay with hacks. If something got hacked, it's like, oh my God, well, code was law and they got hacked and that was allowed by the code, so stop whining. That's not really the way it is. I mean, when a hack happens, everyone knows that this thing didn't behave properly. And there is an off-chain social consensus that is part of the process. And the analogy that we can use is when a real life law goes wrong. If someone, writes a law, if Congress writes a law, but then it's being used improperly or it has unintended consequences, we often go to court and we legislate what was the intent of the law. And so crypto doesn't have a court system right now. The best we can do is this off-chain social consensus. But eventually we might have a court system that will allow us to arbitrate irregular execution of the code. Projects like Claros or Aragon are working on things like this. So when I say code is law, I'm really talking about forming these business and financial agreements in smart contracts. But it doesn't mean that a hack is acceptable. A hack is not acceptable, and you do have to mitigate that in some way. But when you allow yourself to interact with smart contracts and you enter this rich ecosystem, you are forming business agreements every time you click a button, every time you send off a transaction. In the traditional legal world, this would be akin to you signing a contract with somebody or performing the duties of a contract you've already signed. So there's just a ton of efficiency that is gained by doing all of this in smart contracts and code. And on the other hand, from a development standpoint, we really take advantage of the open source ecosystem by allowing people to fork the code and improve upon it and have an extremely rapid pace of innovation. If you imagine the analogy in the real world would be if every single legal contract in the world was available open source for you to review, and you could just go copy and paste these and change a few things. That's what we have in the crypto world today. And so when someone comes out with some code that's doing something interesting, we often see forks like Uniswap to SushiSwap or Olympus DAO to now Klima Dao. And there's always some incremental improvement, and it allows us to innovate much more rapidly. So code is law not only gives you performance and scalability improvements on the execution side, but it also gives you a much more rapid pace of innovation. And taking to the extreme, with now people running nonprofit DAOs on the blockchain, some people are talking about creating some sort of crypto society whether it's, including a universal basic income, or it has some identity system, court system, etc. Something like this is going to have its law in code. Now, just imagine if you could take the entire United States law and fork that on GitHub and make some changes. How much more efficient would lawmakers be if you could do something like that? I mean, I don't even know if you can compile the entire United States law in one document. Where is that document? It's not anywhere. You'd have to scatter, a bunch of people around looking into archaic legal documents to really compile this. But with the code is law, we have a lot more understanding of what we're actually getting, since all the code is out there for people to review. And we have the ability for anyone to fork the code and make the changes that they want, and let the market decide what is the best solution there. So code is law really is the core value proposition underpinning all of crypto, in my opinion. And again, it doesn't mean that you have to accept code as absolute. There is a social consensus around it, but we have so much benefits to this that I think really people need to open their minds up to this as what's really going on in crypto.
Well, a lot of these protocols aren't technically formed entities within the U.S. jurisdiction or any jurisdiction at all. So that's one aspect. And then the other aspect is, we'll call it the code. How do you see this as playing out in a court system when a lawsuit comes? And, how long will it take for even the court system to have an understanding of what's happening within the code to be able to make a decision?
Yeah, so it's going to come down on a case-by-case basis to how effectively can the courts enforce their law. And this kind of enters into the topic of crypto law versus fiat law or traditional law. And it really depends on who is involved and what countries are involved, and the stakes at play. For instance, a lot of DeFi founders are anonymous. So if some user is upset with what happened with their usage of that protocol and they try to sue somebody, well, if they don't know who to sue, then there's really nothing they can do about that. They can file a lawsuit against a John Doe or something, I guess, but the court's probably just going to throw it out because they're going to say, what do you want us to do? So in that case, there's really not much people can do. But if there is someone you can identify, if you're a US citizen and you know that this other US citizen created this app that you used and then you lost your money and you want to sue them, that could happen. And we're still in the testing phases of what actually happens there. I don't think there's been a case yet in US law where someone has tried this. So it's really hard to say how the United States law is going to work in this scenario. And when it comes to judges interpreting code, that's going to be a challenge for them as well. Some people are actually working on a form of code called Ricardian contracts. And the idea is that the code is written in such a way that it looks like legal text, so that you can have a lawyer or a judge interpret it, but also a software developer interpret it, and also a computer can run it. So that sort of middle ground might be the way to go for a lot of the more regulated side of DeFi. But on the unregulated, anonymous founder side, that's going to continue to just be running off, doing its own thing at an extremely rapid pace. And I don't see there's any way of stopping that from a traditional legal standpoint. They're just going to have to learn to live with it. And there's going to be, conflict. There's going to be people going to jail. There's going to be fines and things like that, no doubt. But it's really an unstoppable force, in my opinion. It's like, trying to ban the internet. It's just not going to happen.
So with, either bugs in the code or, some way for someone to exploit the protocol in exchange for the tokens, whose responsibility is that at the end of the day?
It's partially the responsibility of the developers, partially the responsibility of the user, actually. So when you use an app, there's typically a huge disclaimer that you probably just click through without even reading. But the point of that disclaimer is saying that by using this application, you understand that there could be problems, there could be bugs in the code, you could lose money. There's a lot of risk here, and the idea that the developers or the app creators are trying to get across is that, hey, we created this thing, but we can never be 100% sure there's not going to be problems. So if you're okay with that, you can use this software, but don't come running to us if there's a problem. And so this sort of implicit agreement that they're trying to form with users theoretically protects them in the case of, you know, a lawsuit or something like that. But again, we have not seen that tested. But just from a ideological standpoint, you know, users really should be aware of the risks that they're taking when they use an application. And if we're going to live in a world where the developers of these apps are going to be, you know, the hammer of justice is going to be brought down on these people every time there's a hack or a bug, then no one ever is going to create apps anymore. You know, you just don't get innovation if it's extremely risky to you as the innovator. And they're all going to move, all the innovation is going to move to whatever country is going to allow people to do that without taking on as much risk. So as a user, you know, you really have to get it in your mind that you are partially responsible for your own loss of funds when you're using a DeFi application. And so that means you need to do your diligence. You need to do your homework. Go see if this has any security audits. Go see what more technically sophisticated people are saying about this project. If you're a developer, go read the code. And then think about your own portfolio risk. Do you have all of your money in one application? That's probably not a good thing, because if that application fails, you lose all your money. So there's a lot of risk assessment that the users have to do when they use these applications, as you would with really any financial product. And then I don't think it's right to just point all the blame on the developers when something goes wrong, because they're not trying to hurt people, they're trying to help people. And if we are going to just put the blame on them, then they're not going to want to innovate. People aren't going to want to take these risks, and that's not what we want.
Well, we did have a hack this week in crypto, correct? Index finance.
Yes, indexed finance with the token INDX was hacked earlier this week, and they actually are trying to go after the hacker now. There's some sort of sleuthing going on about finding this hacker. It's kind of an interesting story to follow.
I think they identified, I believe, or at least they're saying they identified, maybe.
Yeah, they claim they've identified the hacker as like a high school student or a young college student, something like that. And so they're really trying to. I think they said they reported him to the police, and they're trying to really catch this guy. This is going to be an interesting case to watch, just from a legal perspective, to see what the government, I think it would be the Canadian government, does about this. If you hack someone and steal money, right, it's going to come down to the courts interpreting this as stealing or some sort of computer fraud. And I'm not familiar enough with Canadian law to know how that works. But certainly they have a strong case that this was a hack, this was a theft, because everyone pretty much agrees, except for some of the weird code is law people, that this was a theft. So what actually happened was indexed finance has a liquidity pool. They use the Balancer platform, and they have a liquidity pool with a bunch of assets in there that they use as an index fund. So you're allowed to trade against this liquidity pool, and that's going to slightly change the allocation of the assets in the pool. So they have a way of rebalancing that pool every now and then to make sure that they're staying close to their target weights for whatever they're trying to do with this fund. So what the attacker figured out was that the way that they set the valuation of this pool is by just looking at one asset and then dividing that by its weight. And so if you've got an asset that is, say, 10% of the fund, then you get the value of that one asset in the pool, and you divide it out to figure out what, if this is 10%, then what is 100% of the whole thing. So that allowed the attacker to take a huge flash loan of a bunch of tokens and dump them into this pool and manipulate the price of that one asset, so that when the rebalance was triggered, it allowed the attacker to essentially drain the fund of all the other assets in the pool and then return the flash loan. So what the fix was for this was, instead of just looking at that one asset to value the fund, you actually just add up all the assets in the pool to get the total value, which is really what they should have been doing from day one. But I understand that they were trying to optimize the gas, optimize the computation, just doing a little bit less math. But yeah, that's essentially what the attacker, what exploit the attacker used. And then in the following days on Twitter, the team was issuing threats to the attacker that they had figured out identifying information, and they offered him or her an ultimatum saying, if you return the funds, we'll let you keep 10% of what you hacked, which I think was something like $16 million worth. So a pretty good bounty, if you ask me.
Enough to retire on for most people, right?
Yeah. So the attacker did not do this, and now they sent his information to the authorities, and we're gonna see what happens. So if I was this kid that did the hack, I would be pretty nervous, because this is a pretty, if a government is going to prosecute somebody for hacking money, this one is cut and dry as it gets. But we'll see what the court system says, and I hope the attacker returns the funds, because the alternative is really not good for anyone in this.
It seems like it could become very complicated quickly, in the sense that, especially if, maybe not this specific case, but, if the hacker is in a different jurisdiction, or, we have such a jurisdiction play that comes in to conversation around this. How do you think this plays out when something starts happening across different borders, whether it's at China and US, or, what do you think there?
Yeah, what's going to have to happen is you're going to have users who are in the same jurisdiction participate in the legal proceedings, whether that's joining a lawsuit or working with the prosecutors. So in this case, you'd have to have Canadian users of indexed finance show up and represent themselves as harmed parties in this agreement. If no one shows up, or if they're in other jurisdictions, the Canadian government's going to have a hard time pushing this through the courts, I think. So that's going to be the key to getting anything done in the traditional legal system, is having the harmed parties of that same jurisdiction show up and say, yes, I was using this and this person stole my money, so let's do this.
And getting those people to participate in what might be a minimal amount, if they're a small part investor, may not be worth it for them and their time.
Yes. Yeah. It certainly, if you only lost a few $100 or whatever, no point in doxing yourself, showing up or whatever, unless you've got some sort of altruistic motive. But you're probably going to incur legal costs and also just your time involved. So yeah, it's definitely challenging for these DeFi protocols to actually use the traditional court system to go after people. And, I think that it's sort of a lost cause. I think crypto as a whole needs to just forget about ever using the traditional court system ever again, ever. Because if we are really trying to go for the prize here, if we're really trying to make this stuff work independently of our traditional legal systems, we need our own court system. We need a way to arbitrate these hacks. And we need to make the system evolve into a more hardened ecosystem. Because if every time there's a hack, we go to the traditional governments, there's not going to be as much pressure to actually solve the fundamental problem of designing systems that are more secure, having a more robust auditing framework and software testing frameworks, and having ways that users can arbitrate in the case of hacks and things like that. I mean, I sort of see on the long term, a lot of these projects having integrations with some of these crypto court systems that allows them to arbitrate in the case of a hack, where there'll either be some sort of insurance fund or there'll be a permission-based system where in order for any money to come out of the system, it has to be approved by this court system, this arbitrator. Like it'll go into some sort of escrow. So something along those lines is what we really have to get to. And if we keep going to the traditional courts, we're just delaying that. And I think that if we get to that sort of system, it's going to run a lot more smoothly for people. And it's also going to allow us to innovate and potentially come up with better court systems than anywhere in the world. I mean, when was the last time someone innovated a court system? Right? 300 years ago? I don't know. I mean, it's been pretty much the same. And if you look at what is going on with Claros and Aragon and some of these other projects, people are really going back to the basics of saying, what are the incentives for a judge? What are the incentives for a juror? And how can we make everyone aligned in their incentives when they come to this system, and really use economics and crypto economic incentives to produce something that works a lot better than the court systems that we have today, where arguably you have a lot of broken incentives for judges that have been in place for a very long time and have a lot of connections. And there's also the problem of if you're rich enough, then the laws don't seem to apply to you. So there's a lot of problems with our existing court system that I feel like people are not giving enough credence to in crypto every time they go running back to daddy and say, please, US government, do something about this. You know, that's not how we're going to solve these problems in the long term.
Well, do you think as new DeFi users come on board, what's kind of your thoughts on getting insurance on your transactions for these type of situations?
Yeah, so I think insurance is going to increasingly become a normal part of DeFi applications. There's been a couple DeFi apps that have actually integrated insurance into their products for the users, where the users don't have to do anything. As soon as you start using the protocol, there's some insurance behind the funds. And I think projects that do that are going to get that longer tail of growth. You know, once you start getting, once you get over the gens, you know, everybody that just apes into a protocol day one or whatever, like those people are never going to care about insurance. But once you actually start becoming a mature product and you want to bring in whales, you know, you want to bring in people with large amounts of money that are going to be depositing in this protocol, and a lot of more professional type users and institutions, that they're going to want insurance. And integrating that into your protocol and making it a seamless experience, which we've already seen can be done, is going to give you a competitive advantage over the protocols that don't. And a big problem with insurance is actually getting people to provide the liquidity for that insurance, because there has to be some sort of capital pool that is underwriting the risk of a hack or whatever problem it is. So if you integrate an insurance platform with your DeFi platform, you're in a sense guaranteeing the people providing the insurance capital that there will be people buying the insurance. Whereas if people have to go out and separately buy the insurance, like if you're using, you know, Uniswap and you want to go out and buy an insurance contract for that, or you have to do that separately, only a very small portion of users are ever going to do that. So it's sort of a win-win for both the insurers and the DeFi platform to provide this tight integration that is automatically providing insurance for the users. And I think we'll see that more as time goes on.
Well, do you think it's more important for a user to, we'll call it, spread their bets across multiple protocols, or maybe be a little more concentrated and have an insurance policy, or both?
I think you want to take a sort of middle ground. You obviously don't want to throw all your eggs in one basket, you know, because if some problem happens with that protocol and now you have to solely rely on that insurance contract paying out, that's a tough situation to be in, because there can be situations where it doesn't pay out, where they didn't cover a certain unknown risk, or there's a problem with the insurance itself, like the capital pool wasn't big enough, or you know, it itself suffered a bug. So you do have to spread your risk out no matter what, even if you are buying insurance. But on the other side, you don't want to spread your risk out so much that you're not able to make high quality evaluations of what you're using. People only have so much time in a day to go and evaluate a project. And if you're going to go use a DeFi app, you really need to do some homework on this and say, has this been audited? Are the developers high quality? Is the code high quality? Or is there somebody that I can trust that can vet this for me? That's the kind of stuff that you really need to look at when you're going to put your money into something. And so if you're going to try to do that for 30 different projects, I don't know if anyone has the time for that. It's just you really need to limit it to where you have enough time to do a qualitative analysis of these projects and make sure that your money is in good hands. But you also don't want to throw it all in one or two. So everyone's going to have a different number for how much time you can do that. But that's really the balance that you're trying to find, is spreading out your risk, but also making sure that you have really evaluated the quality of the projects you're putting your money in.
All right, well, let's roll on to the next topic, right? That's been big in the news last week, and that's been the Bitcoin Futures ETF.
Yes.
It's already come out, it's billions trading. What's your thoughts on it? How's it going?
Yeah, so it's been pretty popular so far. I'm surprised at how much money went into it. I think it was in like the hundreds of millions of trading or AUM, sorry, within the first day. And did it get to $1 billion already?
I thought it got to at least 1.1 or something I've seen.
Yeah, I'm pretty sure it did. So that's very good for an ETF. I think it's up there in the top few ETFs in terms of popularity in the opening stages. So I'm quite surprised at that, because this ETF is really not that great of a structure for an ETF, a Bitcoin ETF, in my opinion, because it uses futures under the hood. So what it's doing is, when you put your money into this fund, it's going to go out and buy some Bitcoin futures contracts, and the futures contracts have an expiration date. You might buy a 1-month contract or a 3-month contract or something. So in order to maintain your exposure to Bitcoin, when you're getting close to the end of that futures contract, you have to sell that contract and buy a new one with a further expiration date. And that rollover, as it's called, does incur a cost to the holders of this ETF. And you can see this with another ETF called USO. It's an oil futures ETF. And there's some good analysis on how much bleed this ETF has had as a result of having to roll over their futures contracts. And people expect this Bitcoin ETF to have the same problem. So you're going to miss out on some returns of holding Bitcoin if you use this ETF as a long-term hold. On the short term, it's probably not that big of a deal. But if you're holding Bitcoin long-term, it would really be better if we had a pure native Bitcoin ETF. If something like GBTC could just be converted into an ETF, right? That would be a lot better. Something where you can just put Bitcoin into the fund and they'll issue you shares. And then if you redeem, they'll give you the Bitcoin back. Very simple fund. And it really asinine to me that the SEC approved this fund, but not the dozen others that have been trying to just be a simple hold Bitcoin ETF. Because now you're going to have a lot of unsuspecting users ape into this ProShares Bitcoin ETF and pay this futures rollover premium without even really understanding what it's doing. And then a year later, they'll look at the returns and they're like, well, Bitcoin did 60% on the year and I only got 30%. What the hell? So, or Bitcoin, it's in a down year and I'm way more down. So this is just not a great ETF for long-term holding. And we really need some more options. And I hope the SEC will be saying this and realize that, okay, fine, we'll approve the other ETFs, which could happen, granted, in the next month or two, as we've got a bunch of these ETFs coming up for their decision date. So it's a little too early to tell if maybe the SEC is actually doing the right thing now and they're just going to approve these other ETFs. That would be great, but they don't have a great track record, honestly, in doing the right thing in crypto. So I wouldn't bet on it at this point. And I would tell people that if they want to hold Bitcoin for the long term, they really just need to figure out how to go buy it on Coinbase or something and hold it there, because the premiums you're going to be paying in the ProShares ETF are not great for long-term holding.
Is that obviously for US people, that's probably one of the simplest way to get exposure to Bitcoin is just to go to Coinbase?
Yes, Coinbase is a great way to just have a nice, secure way to store your crypto assets. If you're a technically naive user, make sure you set up your two-factor authentication, and you've got your identity verification, everything squared away there, and you can store your crypto there reasonably safely. Of course, if you are a true crypto diehard, you're going to want to self-custody with a hardware wallet or something. But for most people, keeping it on Coinbase or one of these big US exchanges is fine. They have really excellent security these days. They've been battle tested for years. So, if you're just getting into crypto, it's a nice way to do it. Certainly better than buying this ETF.
For those just getting in, they might get on the Coinbase and see a bunch of different tokens, right? And they're typically, they don't display the market cap or anything like that, but they display the dollar amounts, where there could be some at 3 cents, some at obviously 60,000. How does one go about kind of underwriting and determining maybe what positions they want to take when they are not familiar with the crypto space?
Yeah, so the number one thing you don't want to do is buy something because it looks cheap to you. So yeah, you mentioned something there that really keyed me off. I see a lot of first-time users make this mistake. It's called a unit bias. That's the term for this. And basically, it means that when you see the price, the share price, or the price of a crypto asset or any asset trading less than $1 or less than some nice round number, maybe $10, maybe $100. People seem to think that it has to be that. Oh, you buy this thing at 50 cents, you gotta go up to $1, because you look at Bitcoin and it's $60,000 per Bitcoin, and this other thing is at 50 cents per unit. So it's got to get there. What people don't understand is that what really matters is the market cap. So you have to take the total amount of tokens in circulation and multiply that by the current price per token. And that will give you the total amount of money in this thing. And that is really the important metric that you want to look at. And so, yeah, you could have a token that's trading at 1/10 of a penny, but there's 100 trillion of them in circulation. So that's why it's trading at 1/10 of a penny. So it's not cheap, because the market cap would still be a large amount. So you want to avoid unit bias. Don't buy something just because the price looks cheap to you. That's not really how it works. And then the other thing is, when you log on Coinbase, yes, you're going to see a ton of assets that probably is pretty confusing to a user with how many are out there. You really need to just pick a couple that you like, that you've done some homework on, and that you're comfortable holding for the long term, that you really believe in the long-term thesis on this. And then every couple months, every quarter or so, look at the market conditions and reanalyze your thesis on these assets, update your models, if you're getting more quantitative, and make sure that you still see the light at the end of the tunnel for these assets. But don't just start buying things and end up with 30 different tokens that you don't really know what they do. That's not the way to do it.
and because they're all a sub penny or something.
Yes. Yeah. That's probably, honestly, the crazy thing about it is that people have done that and made a lot of money. I'm not going to deny that. One of the greatest trades of all crypto has been buying Dogecoin a few years ago and selling it at the recent high. And no one would have predicted that years ago. So crypto is just this wild and crazy market where sometimes even horrible strategies work. But that doesn't mean that you want to take a horrible strategy as how you invest. You still need to be detailed, analytical, and risk averse when you're putting your money into these things. And you can't just get these, you can't just look at these shiny objects that are moving in price on whatever day and throw your money at it because it's moving. You really want to make sure that you have a qualitative understanding of what this asset is doing, why it's valuable, why it's going to grow into something in the future, and make your decisions based on that, as opposed to these more pumpamentals and these pump and dump type of things going on every day.
And what do you think about anything to kind of add to just position size and kind of determining, for new users, how, I mean, at least in our experience, right? Sometimes you put the smallest amount in the ones that do the best somehow, but how they can maybe position size and, across multiple tokens.
Yes. So you generally want to size your positions based on two things. Number one is how much conviction do you have in this asset? Does it have a really solid team? Is the code really great? Is the idea really great? Is there a lot of future growth for this project? Those sorts of things. You're going to want to come up with some way to evaluate that. And if you're really high conviction about something, that you do want to increase your size of your position in that. And then the second thing is going to be, what's the market cap of this token already? What's the liquidity of this? Sometimes if you're a larger investor, there's not enough liquidity to reasonably put in what you would want into a project, because just the act of you buying in would push up the price a lot, and you're already basically at a loss from day one that you have to make up. And then if you ever sell this thing, if you have to sell it in a bear market, God forbid, it's basically going to be zero because there's no liquidity. So you do have to take that into account. The other thing to take into account with market cap is that a lot of times you can view the market cap as validating your thesis. So there is a sort of convexity to crypto where sometimes the more something is going up, the more you actually want to buy it as opposed to less. Because some analysts would say, oh, well, it's already gone up by X amount, so therefore it's closer to its theoretical maximum, price. So I'm not going to buy as much of it. There's not as much returns left. But on the other hand, with crypto, there's network effects with a lot of these assets, where the more people that are using it, the larger the market cap, the larger the liquidity, the more valuable that thing is. So a large market cap can actually be part of your validation and your conviction. And by saying that, oh, a lot of other people believe in this asset, a lot of other people are putting their money on the line, and it's got a large community and a user base, so that is going to increase my conviction on this asset. So by looking at both your conviction and the market cap and thinking about how those tie together, that's going to be how you're going to want to set your position sizes.
Nice. All right. Well, look, I think we covered a few things. One last topic we got left for the day, right? Klima Dao.
Yes.
I mean, tell us what is happening there.
Yeah, it's a very interesting project that just launched on Monday. So Klima Dao is actually a fork of another project called Olympus DAO. And Olympus DAO is this sort of Ponzi scheme looking system where it basically, they're trying to create a stable-ish currency. But before they create that product, they want to bootstrap a lot of liquidity. It's sort of like they're trying to get a lot of people to buy into this currency and provide liquidity. And then once they reach a certain amount of liquidity, billions of dollars or whatever, that liquidity is going to backstop this currency. And it's going to be less volatile because there's so much liquidity. It's going to be harder to move the price of this thing if there's already a ton of liquidity. So in order to buy this currency, which is called OHM in Olympus DAO, you have to provide liquidity, and then you give that liquidity to the DAO, and it in return gives you the tokens. And so there's this sort of winding up of a spring where people are buying the token, putting in liquidity into the DAO, and the DAO owns the liquidity, and that liquidity is sort of backstopping the price. And analyzing this system is actually quite complicated to understand, how it really is going to work in the long term. I mean, right now it's obviously in a growth phase. There's a lot more people coming in. And as long as that's the case, yes, the price is going to keep going up. But this system is so new and it's got such complicated economics at play. It's really hard to say, is it actually going to work? And then on the demand side, it's like, I don't personally see a lot of demand for a stable-ish currency. I think that if people are wanting to get out of the volatility of crypto, they go to their fiat stablecoin, USDC or euro or something. So I don't really see a lot of demand for this thing as it is, and that was my problem with Olympus DAO. Now we've got Klima DAO, and what they did is they forked Olympus DAO, and they basically said, we're going to make this system suck up carbon credits. So in order to issue the climate token, you have to buy carbon credits and then throw it into this DAO and effectively locking them up. And the point then is, by buying Klima, you are indirectly supporting you're indirectly fighting climate change, in other words, because you're basically supporting the price of carbon removal. And so if you've got some carbon removal project, whether it's, planting trees or scrubbing CO2 out of the air, those are creating these carbon credits, and those are then issued on the blockchain, and then people can buy those and lock it up in the DAO. And so the demand side of the Klima token is that people will theoretically be buying this as a ideological donation to the world, if you will. So they're not trying to create some weird sort of low volatility currency. They're actually trying to do something that's got more of a humanitarian perspective to it. And that, in my mind, checks the last box I had with my problem with Olympus DAO. And so if you are going to be using Klima, you're going to be providing liquidity in there and speculating on the token. What you're really speculating on is that, are there going to be enough people that want to basically donate money to the cause, if you will, by buying this? And if you get in early, you could potentially see a lot of growth from that. But again, it's a new project. It's highly risky. There's a lot of complicated economics at play, and there's probably problems that are out there that haven't been found yet with it. So it's highly risky, but it is a very interesting project because it's basically taken this liquidity black hole concept from Olympus DAO and used it for a humanitarian purpose. And I think that really resonates with a lot of people in the crypto community. And it's certainly been, one of the most projects with a lot of buzz going on recently on crypto Twitter.
So do you think the project has all good intentions, and how does, maybe even newer investors kind of do their own underwriting or due diligence on it, where there's probably a lack of information out there?
Yeah, there's not a whole lot of information. They do have some Medium posts you can go read. They do have some code you can go look at, but other than that, there's not a whole lot of information. I mean, some of the team is anonymous, most of the team, as far as I know. So at this point, people that are putting money into it, hopefully it's just money that they can afford to lose, and it's at this point just a lot of DeFi degens who are just kind of throwing money at everything that moves. Which is fine. Again, if you can lose that money and you understand that it's, pretty much a coin flip at the end of the day, fine. That's the stage that this project is still in. It's just so early and so untested that I really wouldn't put any significant amount of money in this for you. But it's something to keep watch, and it's something that could turn out to be a very solid project if they are able to go through the ballot testing and get a little bit more refined with the code and the quality of the team. Just to mention the code, I mean, they already ran into 2 or 3 bugs when they launched it that were like, it was pretty basic bugs that could have been caught if they did some amount of testing, but it didn't look like they did much of any testing on their code. So just be forewarned that this code is potentially pretty rusty.
So if they fork the code, is this, this other audit, is this what they do additionally on top of the forked code?
Yeah, so they did have to make some changes to the code to get it to work, because they basically had to add in a new token, these like carbon credits into the system. And the bugs that I saw actually were on their front end. So on their website, there were certain like buttons that weren't working and fields that weren't showing up. And this stuff, it would have been pretty basic in my mind to hash out in some testing, where you have some users go in and try to use the app on your testnet and see what's going on. So the fact that they didn't catch these bugs that they looked like basic math errors or basic JavaScript errors, that's a little concerning. But I think that this is one of those things where in crypto that a lot of times these projects start off really shoddy and start off with kind of a small amount of people. They don't quite have the talent that it takes, but they get enough of a community, they generate enough critical mass that people just sort of show up and start working on this thing. And it does turn out to be a legitimate project at the end of the day. So it could turn out to be that if they garner enough community support. And I think the humanitarian side of this might be the pivotal issue for them to get a lot of interest from the community and get a lot more developers showing up to work on this.
Do you think as long as they're transparent with all that, then more people will join?
Yes, I think that if they can be transparent and they continue to demonstrate their values to the community, then I think that a lot more people will be interested. Again, it is sort of pinning on this Olympus DAO system of this, liquidity black hole. And I know there's a lot of people, myself included, that are skeptical of the economics of this system because it feels a lot like a Ponzi scheme, to be honest. I mean, it's got some Ponzi-nomics in there, and it's not clear how to value this thing, or it's not clear how to know, when you should buy or when you should sell, when is it overvalued, etc. It just sort of feels like it's trying to, the system is trying to like distract people from all of that and just say, look, it just keeps going up, so buy it. So there's a little bit of that going on. And hopefully we get some people come out with more detailed analysis of the economics here, and they can point out the pitfalls and point out, when is there going to be problems, or what problems do we need to fix in the economics. I think some of that's going to have to happen before this thing really gets a large amount of money coming in.
And for those that may not know, what blockchain is that on?
Right now it's on Polygon. Yeah, so it's on the Polygon, formerly Matic sidechain of Ethereum. And Polygon has a nice bridge if you want to bridge your assets over from Ethereum. So like you would need to bridge over USDC from Ethereum so that you can buy if you want to put money into the system.
All right, well, cool. I think that's it for today. We covered everything. Any closing words?
Well, the market is popping right now. Everyone's feeling bullish in the markets right now. It looks like we're going to finish this year with a strong Q4, and that's all great. And if you're new to crypto, just take all of what I've been saying and do your own research, do your own homework. Certainly, this is not investment advice for you to go buy anything we mentioned here. But just be careful and methodical in your investing decisions. And if you do that, you're going to be way ahead of everyone else.
Well, thanks for coming on today, and everybody join us again next time.
Thanks, everybody.